Hi, good morning. Welcome to Flip Monday webinar. Okay, this is Yongkai here, the US equities analyst. So today will be the part 2 of our third quarter earnings updates. Okay, one of the companies that we're going to present on today, right? We already actually issued reports throughout last week. We have a StarHub, SingPost, SIAEC, GLP, OUE, Heng, Valuetronics, Keppel, and SembCorp from SGX. And for US, we have Genworth. So I will just start with Genworth first. General Financial, the quarter. So as you recall, we first initiated a trading buy on this company at $10.57 per share more than 1 year ago. So it actually went up as high as $18+ before coming down all the way even below our cost price until $8.41. What exactly happens? Okay, so other than what I have on the slides here, right, in short, because of the long-term care insurance, actually was quite troubled. Recorded some increase in provisions to the claim reserve. So the market was quite disappointed and actually overreacted and sold it down by more than 30% in 1 day. Okay, so what we over here, right, you look at the bottom right corner, we have the sum of the past analysis. Actually, even if you value long-term care at 0, you are still looking at a target price of $12.57. Why? Okay, the mortgage insurance itself, right, they are already worth around $10.92 per share. Okay, and this is more than today's share price. Let me just recap what is mortgage insurance again. So traditionally, the borrowers have to have at least 20% down payment. If they have less than that, the banks will require them to buy mortgage insurance from Genworth and the peers alike. So in the event that the borrower defaults on the loan, the bank will repossess it, monetize your property, and any shortfall will be paid out by Genworth. So because of the US housing recovery and strong property market in Canada and Australia, actually this division has been very profitable in the last 5 years. And which is why you're seeing that these assets actually on a standalone basis will have been worth $10.92 per share. Okay, so from what we think that this company is very likely to attract activist investors to lobby for a breakup. Why? There's a few reasons. Firstly, previously actually John Paulson, the billionaire investor who's invested, actually also came out to say publicly that this company is actually worth more broken apart than together. Secondly, the management actually they have actually been actively divesting the assets. They are not empire builder. And thirdly, the management actually doesn't really own much shareholdings. So this company is especially vulnerable to activist investors coming to lobby and demand for a breakup. So again, the life insurance, the book value itself is roughly around $7.5 billion. But today, because assuming that long-term care is 0 and fixed annuities, life insurance together add up to $2 billion. So we think that this is actually a very drastic worst-case scenario basis, and we have really heavily marked down from book value. So the sum of the parts, if you look at it, $12.57, book value excluding AOCI, which is essentially unrealized gains on this fixed income portfolio and the derivatives, and also the book value of $30.54 all in. So from what we see, actually this implies that it's unlikely to see permanent impairments, and we don't see much distress in the near term, even if Moody's and Standard & Poor's downgrade its bond rating. Okay, so again, at today's target price of $12.57, we're looking at nearly 50% upside from the last closing price. Thanks. Okay, moving on to my colleague.
Hi, morning everyone. This is Colin, the telco analyst. Today I'll be giving an update on StarHub, which has recently announced its third quarter results. Mainly, service revenue was down for the quarter, which was mainly due to a drag due to broadband decline amidst intense price competition. However, the decline was offset by growth in other segments, which are namely mobile, pay TV, and its fixed network services. Third quarter earnings, however, was up 2.5% year-on-year, which was mainly helped by higher next generation nationwide broadband network adoption grant of 17 million that was recognized in the third quarter. However, over the 9 months period, year-to-date earnings were still down 3.8% year-on-year at 276 million. Higher equipment sales was also recognized due to a strong demand for the iPhones. Going forward, we expect for the fourth quarter seasonally weaker earnings in the current fiscal year, mainly due to foreseeable higher handset sales as well as due on the back of the demand for iPhones as well as newer handsets such as the Samsung Galaxy Note. And this will mainly lead to margin compression due to higher handset subsidies being incurred. Overall, on the outlook, we still expect a higher mobile data usage to continue to drive mobile revenue. With 59% of its postpaid customers on the third plan, we still believe there's room for upside on mobile data growth. Pay TV and the broadband, on a positive note, continue to gain in its subscriber base, and we expect broadband prices to be stabilized at the current level. So this will be a good thing for StarHub, as it implies a limited downside for its broadband ARPU, or average revenue per user. And of course, on the fixed network services, StarHub continue to gain on the back of higher take-up of enterprise solutions, which will drive the growth in this fixed data and internet services revenue, which will offset the decline in voice revenue. So overall, based on the latest earnings update, we have revised our earnings forecast estimates, and we are maintaining our neutral call with a slightly lower target price of $4.25 since our last update, where we downgraded StarHub. The share price has remained quite stable since then, and has only declined about 2% since our last update. Moving on, for SingPost, it has announced its second quarter earnings. Revenue is up 8% year-on-year, mainly due to the strong boost in e-commerce growth, and which was offset by the decline in its traditional domestic mail business. And going forward, we still expect declining domestic mail to be a key challenge for the postal company. Overall, on the quarter, for the second quarter, net profits was up 5.5% year-on-year, which was mainly due to one-off costs in the previous year. Adjusting for this one-off cost, over the 6 months period, adjusted earnings was only slightly up 0.8% year-on-year, and has remained quite flat at about 74 million over the 6-month period. On our outlook for SingPost, we continue to see that the group will still deliver strong growth in its top line as it continues to expand its regional e-commerce logistic network, and also increasing its customer base, mainly for its e-commerce business. New customer acquisitions includes Zalora, Rakuten, as well as Uniqlo, which has tapped on the SingPost end-to-end e-commerce solutions, which also includes designing of the online stores mainly for these customers. However, on the downside, we expect that margins may be weighed down from higher operating costs, as well as future merger acquisition activities related costs due to expansion of the e-commerce logistic business. Some update on the recent announcement of the new integrated e-commerce hub. The project is estimated to cost about 182 million, and this hub is expected to be ready in the second half of 2016. So the rationale for the e-commerce hub is mainly to cater for growth in the e-commerce logistic business, and management sees with the new hub, there will be a 30 to 40% improvement in the cost efficiency, and as well as to cater for significant growth in the logistic business. And with a healthy current net cash position of 449 million, SingPost will be able to finance the new hub internally, and also there's still excess cash to support financing of future investments opportunities in the near future. Based on the latest earnings, we have trimmed our earnings estimates slightly, about 2%, mainly to reflect the flat year-to-date earnings results. And in view of the strong growth prospects ahead, we are maintaining our accumulated rating and with a revised target price of $2.03. Since our initiation on SingPost, the share price has actually gone up close to 10%, and we expect that due to the current status, there may be limited upside on the share price. However, key rating catalysts will include announcement of further deals as an expansion of its e-commerce business. Right. Next, I'll hand on to my colleague to cover on SIA engineering.
Morning, this is Richard, analyst for transport. So I'm going to talk about SIA Engineering, which announced their second quarter results last week. So you can see it's quite bad. The revenue was down 3%, and EBIT was down 44%, associates and JVs down 36%, and consequently the flow through to PATMI were also plunged 40%. So how you read this table? So this is the results for second quarter of this year, second quarter of last year, and this is first half of this year, first half of last year. And so this is the year-on-year change, year-on-year change. This is blank because SIAEC only reports these business segments half year on a half-yearly basis, so you would see them here. So you can see that the airframe and component overhaul dropped 9%, while fleet management was up 21%, and line maintenance was roughly flat at 2.3%. So for the revenue, the quarterly revenue year on year, actually what happened was they had a higher fleet management revenue, which was offset by the lower airframe and component overhaul revenue. And the decline in EBIT was due to higher subcontract costs. The higher subcontract costs were attributed to FMP. FMP is their fleet management program, this business segment here. And decline in associates and JV. This is primarily their joint ventures with Rolls-Royce, SESO, and IECO. SESO does the maintenance of their engines, the Rolls-Royce engines, and IECO does the maintenance of the components of the engines. So the customers, which are the airlines, were extending their service cycle, and they had retired their older engines. The immediate outlook for SIAEC is that their customers are extending the maintenance hours of their equipment, and thus they are deferring the jobs to SIAEC. And consequently, in the long term, this longer maintenance cycle will result in less frequent jobs for SIAEC, but this would be partially mitigated by fleet growth. And one last thing that's not in the slide is that SIAEC had announced an interim dividend of 6 cents. This is lower than last year's interim dividend, which was 7 cents. Yep. Hand over next to my colleague Caroline.
Hello, morning everyone. This is Caroline. First, we'll cover on GLP. GLP has announced the second quarter of financial year 15 earnings. The earnings has been impacted by one-time FX losses. For the first half of the year, the revenue has increased 25% year-on-year to 362 million. It's mainly driven by the strong listing and rental in China upon the completion of the properties, and also contribution from the recent Brazil BR properties portfolio acquisition. And of course, this is also partly offset by the weaker yen and the Brazil real. The first half of the PATMI was down 25% year-on-year to 269 million, attributed to two reasons. One is the one-time FX losses of about 53 million arising from the contribution of the Japan and the Brazil assets to the fund management platform. And second is the higher minorities after the sale of 34% of their China business to a group of consortium of the state-owned enterprise shareholders. It's adjusting for this, the first half of the pro forma earnings will be up about 12% year-on-year. Positive China outlook amid slowdown. The listing demand in China remained healthy. In the previous quarter, about 810,000 square meters was leased, this is a 42% year-on-year increase. The China development starts is for the first half of the year is about 846 million, which is on track for the whole year target of 1.7 B USD. Completion for the first half of the year is lower at about 500K per square meter, but for the second half of the year we expect a ramp up. 700K will be expected in the next quarter, in the coming quarter, and the balance will be expected in the last quarter. The balance 1.2 million will be expected in the last quarter. GLP remains confident on their China business as the supply still remain constrained and demand to be driven by the domestic consumption. However, we feel that there should be a slowdown in the rental growth, not expecting as much as the previous years, but they were still likely to maintain a 4 to 5% rental growth on a year-to-year basis. And from what we understand, about 67% of the demand still come from their existing customer. Another point to look is the rapid expansion of the fund management fee income. The fund management fee has actually increased 87% year-on-year in the first half of the financial year 15, contributed by the development and the acquisition fees accordingly. GLP has recently also expanded their fund management platform by about 2.5 billion USD. Basically contributed from the divestment of the BR properties to a new Brazil Income Partners 2 fund, with the China Pension Fund Investment Board and another North American institution investor. GLP will still maintain about 40% in this fund. Another also is the expansion, divestment of 11 properties to the GLP J-REITs, and also 2 additional funds injection into the Brazil and the Japan development funds. So GLP has also indicated their intention to form a second China development fund, as they see very strong demand from their capital partners. We expect the earnings from the GLP platform to increase in years to come. We continue to stay positive on GLP outlook, though short-term earnings will be affected from the divestment of China and the Japan assets. We maintain accumulate with lower target price 3.023 to account for weaker FX movement. Next, OUE results. OUE third quarter results revenue reported at 106 million, a drop of about 10.8% year-on-year. This is due to the lower residential sales income, which only 1 unit was sold last quarter, and also the lack of contribution from the China's hotel, which they have disposed last year. The PATMI was, however, up 23.1% year-on-year to 16.5 million due to lower finance expenses and higher contribution from their associate, which this we have actually mentioned in our previous quarters results. However, due to the lower contribution from the first half, lower earnings from the first half of this year, the 9-month earning forecast only represented 50% of our FY14 estimate, which is below our expectations. With the view that local residential market outlook to remain challenging, OUE shall focus on enhancing the commercial portfolio to boost the recurring income. One is the development of the extension building next to the Crown Plaza Changi Airport Hotel has commenced in August 14 and will be expected completion in the late 2015. AEI's asset enhancement initiative at OUE Downtown and US Bank Tower observation that are also in progress. These AEIs is expected to be completed in the year 2016. We do see a visible earnings pipeline upcoming, but we feel that it will be a while for OUE to enjoy the full benefits of the ongoing AEIs project. And although the investment property division will likely to continue to enjoy a good performance into the 2015 on the back of tight office occupancy, but we feel that the rental growth will likely to slow in the late 2015 or early 2016, as there will be huge upcoming office supply in 2 years' time. So with that, we actually revised our price downwards to 2.52, but still maintain our accumulate rating. Next, I shall pass on to Benjamin, who will be covering on offshore marine. Thanks.
Hi, good morning to everyone out there. Benjamin here speaking. Alright, I'll be covering on Keppel offshore as well as Keppel and SembCorp as well, just to give you a brief overview on the offshore sector. Right, for Keppel, they posted the 3Q for revenue about 14 mil, right, net profit of 1.2 mil. Right, so this quarter, Q&Q wise and year-on-year wise, wasn't too good of a performance again. Right, this is largely similar to last quarter, where they saw delays in customer rigs and OSVs. Right, to give you a bit more background, this Keppel usually is a company that services rigs. So that's dependent on the value of the rigs they service, as well as the number of rigs that comes in to Singapore waters for them to service. Right, so for this quarter, the last quarter, right, they actually had a number of rigs that were supposed to roll on to be worked on, right? But those rigs were actually waiting for contracts from the integrated oil companies. So integrated oil companies will charter or rent these rigs from the asset owners. So when asset owners have not received a contract date yet for their oil rigs, that's when it's delayed, right? Sometimes from towing from West Africa or from the Brazilian waters into the Singapore waters to be serviced. Right, so for the 9 months revenue, it was 2% lower year-on-year only, right? But net profit was impacted quite a lot if you compare year-on-year wise, because of the different types of product and margin mix. Right, so for last year it was about 43%, right? This year it's about 36%. Right. For current forward commitments are still quite high. Last quarter it was for 2Q it was about 86 mil. So for 3Q it still stands about 80 mil. So currently for the next quarter, for the last quarter this year, about 6 to 7 rigs will be serviced, and these 6 to 7 rigs are from Noble, the US asset owner, right? And currently 2 are already being worked on their yard. So these 6 to 7 rigs will be recognized in the next quarter, which is about 10 to 15 mil, right? So that's already probably more than these 3Q figures over here, right? For the remaining of the 50% of the 80 mil commitment, they'll be spilled into FY15. Right, some of these comprise of the Oro Negro rig, right? That's going to be pushed out from PPL shipyard by SembCorp. So the Oro Negro rig was supposed to be delivered by the SembCorp shipyard in SembCorp yard in 4Q of this year, but the Oro Negro rig was waiting for a contract. So this has been delayed to first quarter of FY15. So this value of the contract is probably about 15 mil, right, to be recognized next year. So currently the key rating catalysts are still high value turnkey projects such as the one I just mentioned, the Oro Negro rig, as well as any accretive M&A that they are looking at. So previously they were looking at the subsea services player, right? But currently with the oil price going down, they're waiting for better valuation to come up for companies that they might look to acquire, right? And as also for the end of this year, they're looking to pay some dividends as well. Right, so currently we revised our target price downwards to 23 cents as we cut our EPS due to them having all these rig delays, which are delays in their revenue recognition. Right, next up for Keppel Corp. They reported the results about 2 weeks ago, so we are presenting it today together with SembCorp. So for Keppel Corp, their 3Q results were pretty good. 8% higher Q&Q, but it's flat. 8% higher year-on-year, but Q&Q wise is flat. Right, so from a few reasons. One is the low contribution from the infrastructure division. That's because of low revenue from less power generation. And their property division, if you strip out their one-off gains, right, they actually had some decline in Singapore and China sales. Right, so last year they actually still consolidated about 2 months of Keppel results. For this year, this absent. And this year, we strip out some of the large divestment gain, which is one of them is the sale of Equity Plaza. Right, so the offshore and marine sector, it continues to perform really well. Right, if you look at Q-on-Q wise, the operating margin has improved from 14.7%, right, and this continues to be the main contributor to the group revenue. Right, total now is about 69%. Their order book continues to be strong, and they secured 0.5 billion of order wins. Right, so year to date order wins is about 3.7 billion. But this is as of the results release. But 2 Fridays ago, they announced that they won another high-spec jackup rig order from Japan Drilling. Right, on the Monday after that, SembCorp also announced that they won a similar contract as well, a high-spec jackup from Japan Drilling. So both of these rigs are about 224 mil. So for management-wise, they are not too fearful of the recent fall in oil prices. Right, and similar to what we mentioned in our webinar a few weeks ago, right, Keppel also reflected that the offshore and marine sentiments are affected by the capex cuts from the integrated oil companies due to the lower oil prices. And we also expect day rates to continue declining, right, going forward into 2015 when contracts are refreshed. And then there's oversupply concerns as well, especially for the deep water floaters. Right, for Keppel, we will understand previously that they are not so affected by the oversupply issue, as well as the lower oil prices, because the global jackup fleet is aging, and then there's a preference for high-spec jackup rigs, which we have seen 2 Fridays ago, where they just achieved another order win of 224 mil. Right, so they are slowly progressing and diversifying the FLNG market, right, which is production-related assets. Okay, for SembCorp Marine, reported their results last week. Okay, their results weren't that good. Right, 3Q revenue was 3.2% higher year-on-year, okay, and 27% higher Q-on-Q. However, the main takeaway that we have is 2 main points which I highlighted over here. Operating margins are flat year-on-year, right, but Q-on-Q wise it's declined to 10%, which is what we were cautious on previously due to them having some execution risks on their drill ship deliveries. So this is what we have seen, where they have more conservative recognition, right, on the drill ship revenue recognition. So that's why we see that the margins have been compressed to 10%. Right, the other part is also the repair revenue, which is usually one of the key drivers for their top line. So repair revenue, the margins are usually quite good, right? 5% up Q-on-Q, right? But the thing is, year-on-year wise, it's declined almost 23%. All right, even though they have additional yards now, additional yard capacity to conduct more repairs. So net order book is quite strong at 12.6 billion, and they secured 1.7 billion of order wins from the last quarter. Right, their first drill ship has finally left Singapore in October. So the delivery is supposed to be on schedule for June or July in 2014. Right, but let's wait to see if there's any delays on this. As again, in the producer side, there's some execution risks on this. But management continues to be positive on high spec condition jackups as well as deep water and ultra deep water floaters. But in our view, we believe that order win momentum should slow down going to 2015, right? Because of oil prices remaining low, right, and cost of exploration in deep water, right, is at risk, right, and does not bode well with of course all the exploration and production capex, right. So we believe that especially for the floater side, which is the semi-subs and drill ships, that continues to be under pressure, under pressure for any form of order wins. Right, for jackup segments, that should be still quite alright going to 2015, right. But overall picture-wise, again, we think this is a drag on rig demands as well as the day rates going forward in 2015, right. Of course, one upside risk is that for SembCorp, now about 50% of their order book is coming from production-related assets like FPSOs. So that's one of the mitigating factors, right, for a compressed order book. Right, with that, I'll end off on the offshore marine side. And hand out to Kenneth to talk about Valuetronics.
Alright, thanks, Ben. Okay, it's Kenneth here. So I'll give you an update on Valuetronics. Okay, so after the second quarter update, we basically think that the stock is now undervalued, even after factoring a pessimistic case. Okay, so in short, right, Valuetronics results were overall acceptable. Okay, revenue came in essentially flat. ICE revenue increased roughly 25% year-on-year, okay, to 225 million Hong Kong dollars due to increased demands, and we look favorable for the rest of the year due to improving US manufacturing sentiment and as well as the revenue contribution from the new client which they have managed to secure in the first quarter. Now, for the CE revenue, where everyone's talking about, yes, it has decreased 10% year-on-year, but we do note that it actually increased 5% quarter-on-quarter. So there is a temporary stability that's going on. So this, the cost competition for CE, while present, it is taking time for it to really come into effect. Okay, we still think there is structural headwinds to contend with regarding the LED business. Okay, however, we do note that a sudden drop in business is pure speculation at this point. Okay, so while we contend there is still cost pressures in competition, but sudden drop in business due to client restructuring is just purely speculation. Okay. Okay, so gross margins essentially only decreased 2.4% year-on-year. Okay, don't forget it's up actually 2% quarter-on-quarter, and the margins remain stable. Okay, so bottom line, net profit decreased 8% year-on-year, but actually increased 7% quarter-on-quarter. Okay, and that does fall within expectations, but just on the low side. Okay, so we think it's very undervalued, and what we did is we modeled a very pessimistic scenario to see what our hypothetical downside would be. So based on, since we already had 2 quarters of stable earnings, right, we modeled a 20% drop in CE revenue for the rest of the year, which is quite severe. Okay, and we also decreased the gross margins by 12%. Okay, so it will drop from a high 9% to 8.3%. And essentially, this just leads to a hypothetical net income contraction of 13% to an EPS of 5.8 or roughly 6 cents. Okay, so to be conservative in our model, we decreased our target PE to 7 times. Okay, it used to be at 8 times because we argued that because we had good gross margins and high net cash position, it should be at least at peer average. But just to be very conservative, because of the there's a bit of less clarity on the CE growth profile, and there's also higher variance of earnings from the ICE and CE side. Okay, so just because of this, we just peg it down to a slightly lower target PE. Now, if you do this, you will get a valuation at 40 cents based on earnings alone. Okay, don't forget that we still have to add in 11 cents of idle net cash. Now, this net cash is actually 60% of the net cash. We are not even factoring all of it. That's so being conservative. And when you do this, you essentially end up, and also, of course, when you account for a possible dilution of all the options, okay, which are in the money, we then arrive at a reasonable target price of 49.5. So we basically upgrade this to buy, that even on this pessimistic scenario, right, we can still find good value on this stock. At this time, let's not forget that the dividend yield is roughly 8.2% right now, and that half of the market cap is essentially net cash. The PE x cash is roughly around 3 to 3.3 times right now. Okay, so that's it for our quarterly updates, and we welcome your questions.
Hi, this is Richard speaking. There's a question on ST Engineering. So the question is, ST Engineering aerospace revenue is also down more than 30%. Are both ST Engineering and SIAEC facing the same issues? Okay, first of all, I'm going to state that we do not have coverage on ST Engineering at the moment. But for ST Engineering, the difference between them is the customer base, and also ST Engineering is in the narrow body. They are operating the narrow body aircraft space, while SIAEC is doing the wide body. And for their engines, they are not competing on the same engine type. So for SIAEC, they were affected by the trend, which is from Rolls-Royce. Whereas for ST Engineering, the engines that they are focusing on is the CFM56, which is a joint venture with Safran and GE. When we attended the analyst briefing for ST Engineering, they attributed their weaker aerospace numbers to their European operations. So actually they have done some divestment of 2 of their European operations, and so and they are doing a reorg in their Europe businesses. Yeah, so they attributed the weaker aerospace revenue to the European sector, which in Europe the recovery didn't happen as fast as they had anticipated it to go. Yep, thanks.
Hello, there's questions on asking on about OUE regarding on the possible headwinds moving forward and why it still accumulate. Number one, although as I mentioned, in near term the AEIs may not be enjoying the benefits, but once the AEI is completed, the recurring income base will improve on the long-term base. And secondly, taking into account that as per now, OUE still have a cash position of which includes the investment in their other current assets in other investments, they still have about 300 mil, which still allows them to actually take on further improvement projects and acquisition. So this is why, and taking in, because we have actually taken into the consideration for the near-term headwinds and revised the price downwards from 2.69 to 2.52, and we still give it a potential more than 10% growth, 10% upside on current price of 2.12. This is why we have actually still maintained our accumulate position. Thanks.
Benjamin here. The question of bringing Keppel Corp and SembCorp at the current price, which is a preferred stock, definitely still on Keppel Corp. But just to reiterate, our ratings on Keppel Corp and SembCorp is at neutral and reduced because of the bearish sentiment on the offshore and marine sector, largely because of the low oil price. But bringing Keppel Corp and SembCorp, Keppel is a better play on diversified holdings, right? Because of their property segment and infrastructure segment. But on top of that, their margins are still holding up quite well as compared to SembCorp. And they usually pay out about 50% of their net profit as dividends. So currently the dividend yield is about 5%. So you're looking for a good dividend yield stock. Keppel Corp is quite attractive currently.
Hi, there's a question relating to the telcos. How do we compare Singtel to other telcos, mainly which are namely StarHub and M1? For Singtel, we actually have a neutral rating quite a few quarters ago, which was mainly due to the we see quite a lackluster outlook, mainly on its Optus, and also earnings was also quite impacted by FX, weaker foreign currencies, because Singtel does have several associates in various countries, mainly in the Telkomsel, Bharti, and also AIS, which was all impacted by weaker foreign currency, right? But however, in the long term, we do see that Singtel has a stronger growth potential as compared to the other two, which mainly due to its international exposure. So once the FX movements and when there's improvement in Optus competition outlook, does have some improvement, we think that Singtel will likely outperform the other two over the longer term. However, for this in the short term period, we still think there's Singtel may still be further impacted by weaker FX, and also whether there will be improvement in Optus. The outlook still remains quite uncertain at the current moment. At the present moment, M1 is still our top pick among all the telcos, mainly due to its strong play in the local market, and also is growing on all fronts due to in mainly fiber broadband as well as mobile. On the Singapore side, right, mainly all three are having declining roaming revenues, but they are still benefiting from growth on the mobile data usage side. Right? And of course, mainly on StarHub, challenges is also in the broadband front, as unlike M1, whereby M1 is a new player in the broadband segment, because previously, before fiber, M1 doesn't offer the broadband service. However, for StarHub, it does have a mix of cable broadband and the fiber broadband, so it may suffer from not only from price competition, but also migration of its cable broadband to other fiber broadband providers. Right, so that was the main challenge for StarHub currently.
Benjamin back here again. The question on is there any foreseen negative impact on SembMarine with the recent impairment charge taken by Transocean? So just to give a quick answer on that, Transocean is one of the asset operators, right, that undertakes contracts from the NOCs and IOCs, by national oil companies as well as integrated oil companies. Right, so for Transocean, the impairment charge has been taken. Right, it's clearly a sign that, leading back to what I said before, that there's a lot of pressure on the deep water floater segment. Number one, from the oversupply issue, and two, right, it's a early indication, I won't even say early, quick indication of next year going forward, there'll be a compression on day rates, hence the net realizable value of these assets are under pressure, and that's why they take an impairment charge. Right, so this is a sign, again, going back to what I mentioned previously in the during our earlier presentation, right, that we see a lot of pressure going forward in terms of order wins for deep water floaters, right, which is evident from what we see from the impairment charge taken by Transocean. Right, so for SembMarine, with their order book, that's largely occupied by orders from the deep water segment. So there's 7 drill ships, right, as compared to Keppel, which is largely dominated by jackups. Right, this is what we see, right, going forward, where there will be more negative sentiments in terms of order wins, especially from the deep water side. Right, so this is one of the early indications that we have seen.
Hello, there's a question that asks, will the expected strong USD and the unsettled labor problem in Brazil taken together have any drastic impact on GLP earnings? From what we see from now, is the impact should be minimal. As for now, GLP Brazil portfolio earnings only takes up maybe about less than 20% of the overall bottom line. So from what we see is it should have minimal impact, and also for GLP, they are also taking very, very close outlook on the FX movement on the beside the USD and Brazil. They are also taking very close monitoring on the FX movement on this. So what we see is the impact should be minimal, as majority of their revenue still generate from the China and Japan portfolio. Thanks.
Hi, we have a question on QT Vascular and NOL, but we have there's a question on QT Vascular falling and what was our update since our last report, but we've actually never issued on QT Vascular. So sorry, no comment there. We have never had coverage on QT. We also do not cover NOL.
Hi, Kenneth here. Okay, so a question on the markets, Dow Jones, S&P. Okay, so for Dow Jones, S&P, the brief summary is like this. Short term, we are basically a little bit overstretched on the short term, and I just say a little bit, not a lot. But on the longer term basis, right, we are still bullish because of reasons like lower oil prices, which would be a boost to global economy, as well as still a low interest rate environment. So taken together, right, we think that the bull market still has legs. But on the short term, we are just a little bit overstretched right now. Yeah, that's basically it. Oh, okay. Here's another market question. From your previous view, broad market is still up. Yes, okay. On wave count, where are we now and what extent move on wave 5? Okay, so what we think is that we have not seen... Okay, so for those of you who have seen my past presentations, and I did for context, I ventured a wave Elliott count on the bigger cycle of the S&P. So based on the wave count, right, we actually have not hit the wave 4 yet. But we have, when I say wave 4, I'm talking about the major wave 4. We have basically completed the extended wave 4, most likely. So the wave 4 hasn't occurred yet. It would not surprise me if the next correction down is the wave 4, the bigger cycle wave 4. We've seen the smaller cycle wave 4 corrected already. When that will happen, I can't tell you. All I know is that on the short term, we are just a little bit overbought, but this is just a little bit of weakness, but not enough for me to say that a wave 4 is coming in the near 2 weeks.
Hi, we have a question on Genworth. One of the readers asked for more elaboration on why is it trading buy. Okay, for context, we actually issued earnings updates last Friday. You can also click on the link on this Monday's morning notes to access this report. Okay, but to summarize, right, a few key takeaways. Firstly, the mortgage insurance assets are worth more than today's share price. Secondly, it's low leverage, only 25% leverage ratio. And then thirdly, the debt maturity, the latest debt maturity will only be in December 2016. So there's 2 full years, and even then, the amount of debt that needs to be refinanced is $300 million, whereas at the holding company level, it actually has more than $1 billion. And also, both this Canada and Australian mortgage insurance are publicly traded. So at one look, you can actually see what is the trading price, and this is another source of liquidity. In short, we think that the market has actually oversold based on the too much focus on the long-term care insurance, whereas Genworth itself is actually more than that. Thank you.
Hello, there's a question on any updates on Cinema Lens. Sorry, just that the Cinema Lens is only releasing the results this Wednesday. We shall provide an update by then. And there's another question that is OSIM a good buy at present price? Frankly speaking, I'm looking at OSIM and it has recovered a little, and I have spoke to the rest of the remisers saying that for OSIM, our take is that we still are positive on OSIM on long term. Just that for now, since the last reporting results, the drop in the price, we feel that it will take a while for OSIM to recover. They will recover, but it will be at a slowly steady state, not a huge jump unless there's a news such as a new acquisition or anything else. We feel that actually it will be recovering at a steady state for this, and I feel that as per now it's pretty attractive. Thanks. Okay, that's all we have for today. Thanks for tuning in. We'll see you guys next week. Bye.